Jamie, good to see you, man.
Hey, glad to be here, man. How you doing, Jason?
Yeah, I'm doing good. Thanks for coming on today. As I was telling you, we'll kind of do just a quick, intro on veteran PCS. But this interview, for those of you that are watching, or when you watch this is mid-September, and this is really all about what's going on with the state of the market, what's going on with interest rates, what's going on with trends, how does this compare to 2008? How does this affect home prices? What can we expect in the future? What are some forecasts? All of these things. So Jamie Fisher, you're a lender here at Colorado Springs with me, small town North Dakota guy, Army vet, crew chief, helicopters, So anyway, I've really enjoyed working with you and hearing from your experience. We got connected through VeteranPCS, which, again, if people aren't familiar with that, it's a website that I started in 2021 as a way for military families to help military families move. So there's just veterans and military spouses that are real estate agents and mortgage lenders nationwide. It helps support veteran and military spouse businesses, so there's no monthly fees or yearly fees for agents. It's a great setup for lenders, help support their businesses. We donate some money back to military focused charities. And then the families, they get a move-in bonus check after closing, which a lot of people don't even know about. So a lot of times, we have these big check pictures and stuff like that, but that's the move-in bonus after closing. So anyway, people can check out VeteranPCS.com, but we'll get into just the content of today. So I get asked all the time, like, is the market crashing? What's going on with markets? So from a lender's perspective, can you just help us understand, like, what is going on with the real estate market?
Yeah, man. Thanks, Jason. My name is Jamie Fisher. I'm the branch manager for Veterans Lending Group here in Colorado Springs. I've been in the industry since 2014, and I bought my first home actually in 2000, the end of 2008, beginning of 2009. So I literally have seen the good, the bad, and the ugly of kind of where things have gone with the housing market, where they are, where they probably will be going. So. But yeah, I just think, Jason, just starting out, I think this is kind of just to set the expectation kind of for folks as to where rates have gone just literally over the last 4 decades. I think it's just good to kind of set a little precedence. So I'm going to share this real quick here.
Great.
I think this will be a good start point here. So yeah, so right here is just off of one second here. This is off Freddie's website, and this is just kind of Freddie Mac's kind of rates where they've been since 1974. They go all the way back. Okay. And then if you guys look right here in the gray, is every time there's a recession, we see rates drop. Okay, but I mean, this is kind of the 70s, the 80s. This is when everybody blames Carter, during his era for inflation, and some of it, is just the times. So, Paul Volcker in the 80s, he took the federal prime rate or the federal fund rate and just jacked it up almost to 18% at a point. And usually the prime rate sits about 3% on top of the Fed rate. So, this is back when rates were 21%. Okay, so if we look, rates have come down pretty substantially. 2008 is really where we had the big issue with the too much surplus, not enough demand. A lot of people see the big short, which kind of really bangs on the lenders and the banks. But really, it was kind of a 3-prong thing. It was the government, kind of set the rules by which lenders could play in, and investors. So the investors, the lenders, and the banks, all three kind of put in motion, things leading up to 2008. Along what was going on during this time in 2008 was builders were building. There was just tons of inventory, and at some point this domino was going to fall. So in 2008, we saw everything kind of deflate out. But one thing to mention, what was kind of going on from 2008 to today, right? So, I think a lot of this has to do generationally. We are experiencing now the baby boomers kind of were in this part here. They had Gen X, which is kind of our generation or my generation. And then we had the millennials coming in, and the millennials are a huge generation. There are about 5 million more of them than Gen X. Okay, so I'll go through a few stats kind of to explain this, but we definitely are in a housing shortage right now, which is where I think is going to continue to see a demand in the housing market. So, this is just kind of like to set the expectation. We're actually getting back here to what has been traditionally a normal market. So this is kind of with higher rates is a normal market. It means inflation is tame, and this is kind of where I think we're heading back to. We just haven't experienced that since 2008 because the last decade has been low rates. That's what people are used to that have bought in the last decade. So, but go talk to your parents. Your parents will tell you. So, yeah. So, anything on this, Jason? I think.
No, I think it's just important to know. I mean, a lot of people, think the interest rate is terrible right now, and really looking at it, it's not bad at all. It's not good or phenomenal, but looking over the trends, it's like we've seen this is very standard or even lower than what we've seen in the past. And I think just seeing this graph is really helpful to see, like, oh yeah, it's even at this interest rate now in the high fives, it's not bad by any means, but just to see over time kind of what happened, and hearing about 2008 was great.
Yeah, actually, this means we're when they're super low, it means something bad is going on, and they're trying to stimulate the economy, right? So that's kind of when rates drop. It's actually because the government's trying to pick the party back up, right? So that's kind of what happened. COVID, 2008. That's why we've seen these lower rate environments. So going on to the payment, I think this is really important to just kind of take note of.
Yeah.
People that bought a year ago during COVID, we were as low as 2.25 on VA loans, right? So, a $400,000 loan, just principal and interest, right? This doesn't include taxes and insurance, is $1,528. And, during this period when rates were low, a lot of people got buyer fatigue. And I'm sure you kind of experienced this, Jason, but what was some feedback you heard when rates were ultra low and a lot of people were looking to buy?
Yeah, I mean, people were offering, $20,000 over, $50,000 over, all this cash over. People were, submitting 5, 6, sometimes 10 or more offers on houses and getting beat out and just getting discouraged because they're like, oh, I can't offer $50,000 cash, to win a house. And yeah, again, this process just kind of kept going on for a lot of people of getting beat out by other offers, because there was, here in Colorado Springs, there was 300 houses on the market at like the all-time low for thousands of buyers.
Yeah, right.
And it's gotten more balanced, but that's kind of what we were seeing, is there was, 20 buyers to every house on the market.
That's what it felt like, for sure. Did you ever get just any closing costs during that period for your buyers, or did you have any luck with that?
Yeah, buyers were covering almost everything. A lot of buyers were waiving, inspections even, or they were covering all of the sellers, closing costs. I mean, a lot of people were doing like due diligence money, in different areas or different states.
Yeah.
Yeah, there was a lot.
I saw some buyers covering the seller's agent's commission, in Denver.
Yeah.
So, I mean, that's kind of what was going on. So let's say, right now, I'm just going to throw what Freddie had in there, a 5.75 ballpark right now. So if we go let's go 5.25, 3%. Let's just make it easy, right? So basically somebody that is buying now in this market, so 1528, they're going to 2208. So, they're going up about $700
a month
in interest, right? So, but, keep in mind, we're right now, what is driving rates is not the Federal Reserve. What's driving rates is inflation. Right. So by the Federal Reserve starting to raise rates, the federal fund rate, it's trying to slow the economy down to make more goods and services available, because right now there's not enough, and that's what inflates prices.
Right.
So that's kind of what we're experiencing right now. So once the Federal Reserve does catch inflation, then prices should start, or rates should start coming back down. That's the inverse relationship between the Fed and inflation.
Got it. Okay.
So I did have, hold on one second. I was looking at this a few days back here, just with inflation and kind of where inflation is coming on. We have seen the biggest jump in inflation since the 1980s right now. In the last year, we've seen as much inflation as it was back in the 70s, the late 70s, early 80s, within like a 2 or 3 year period. So inflation is really out of control. Right. And what drives inflation is what's called the CPI. So every month you get a CPI reading, which is a consumer price index reading, and that shows that the cost of gas is up, the cost of food is up, the cost of oil is down. So they calculate all these into a number, and this number, one second here, yep. And this number basically is what each month they assign it a number, and you add up all those numbers, and that gives you the inflation report. So what ends up happening with the inflation report is they look for the consumer price index to start coming down. So like January, or what month are we in here? September of this year will replace September of last year. So the inflation numbers just came out I think today or yesterday. They were at 8.3, which is a little bit higher than where they projected, but it's lower than where it was last month. So it's starting to come down.
Okay.
So that's what we're going to see in the next 12 months. I think we're going to start seeing inflation. The Federal Reserve is talking about on the September 20th here, they're talking about another 0.75 hike, which is again going to slow that party down. Right. And it's going to make it more painful to buy stuff. And eventually what happens is less people start buying, and then it starts dropping inflation. So,
okay. So that related to, so yeah, back to this. So with house prices and everything like that, or talking about a military family active duty or something like that, that's, their BAH does not fluctuate as fast as, rates do, and it doesn't adjust for stuff like this that fast. So, if somebody has whatever a BAH, here in Colorado of like $2,000, before, or, when the interest rates were at 2%, they could qualify for a house that was probably closer to, 500,000 or something like that. Whereas now they're looking under 400,000.
Correct.
To be at the same month.
Yeah. As rates go up, purchasing power goes down.
Got it.
So, 400,000 back here, you add about $200 for taxes and about 150 for insurance, right? So back here, $400, make math easy, 1928 would get you about 400,000 for where BAH was for an E5.
Right.
So what ends up happening is, now, add another $400, we're at 2,600 for 400,000. Well, every $20,000 is $115 of purchasing power, right? So we basically have to drop, if you want this 2,600, right? We added 200 for insurance and 200 for taxes. If we want this to go down to BH, that's $600. It's a $120,000 swing. Okay, so reality, 280,000 is where we're going to want to be. 400 bucks on there, that's where we're going to want to be to get 2,000. So when people were waiting, right, because they wanted prices to come down, well, what ultimately they did to themselves is now they just can afford less because prices haven't come down significantly. Maybe 10% here they've come down over the last 6 months that I've seen. And I think there's going to be another 5 to 10% drop probably between now and February.
Yeah, median home, just to back that up, we were looking at the median home price, and it peaked this year at 490,000 here in Colorado Springs. And then over the last 3 months, it's dropped to 465. So it's come down a little bit from 490 to 465.
Okay.
This
Yeah.
month in September.
Yeah, and I would
not as much of a difference to offset the significance that interest rate makes.
right.
You know, where 280,000 is still incredibly hard, if not impossible to find. Here in Colorado Springs.
Yeah, you'll be living in the sticks. So I think rates. So it's kind of to give the equivalent. I always like using this equation too. So let's say rates are at 5%. So we're looking at 1610, and rates go up 0.5%. So 5.5, right? So this traditionally has been about $25 every eighth of a point. So it should be about $100. 95 bucks or whatever. So $100 in your monthly payment is 20,000 of purchasing power. You just lost.
Right.
Rates went up 0.5 point. You just lost 100, or you just lost $20,000 of purchasing power. Right. So I tell people it's more important to be focused on rate than price point.
Right.
Because a lot of people, they wanted the price point, not the rate. And had you bought back here 400,000 when rates were at 2.25, oh my goodness, you're a BAH for 400,000.
Right.
So that's kind of where people they look at price, they don't look at the interest part of it. So now everybody's waiting for what to come down, not prices. Right. So whatever's high, that's kind of what people are looking at. So what I'm counseling a lot of buyers right now, and kind of going to the housing forecast, Jason, this is kind of just something I like sharing here. This is a really cool slide because mortgage rates and recessions happen about every 10 years. That's kind of typical. Okay. So here's the 80s. They had it in the 70s. Here's where rates went up. They went from 16% up here because they entered into a recession. They dropped all the way down to 11.75. Then in 1982, this is again, they were at 18%, and then they dropped down to 13% in the recession. So 1990s, we had another one. We went from 11% to 8.75. Another recession here in the 2000. This was the dot-com bubble. We have cool names for them now over the last 2 decades. Yeah. This was like the Carter recession, and here's the Bush. So it's funny, but here we had the dot-com bust. We saw rates drop, not significantly, but right here, 2008, is really when we started seeing rates drop, and we had a banking crisis with liquidity. We had a housing crisis with too much demand and not enough surplus, or I'm sorry, not too much surplus and not enough demand. And then, this is where the government really started intervening to prop businesses up. So we saw 6% to 4.875 right in this period. And then, they dropped all the way down to 3.25 here because I refinanced right about there after buying my condo up here. And then we saw, COVID, short-lived, right? And the government kind of was stimulating the economy a little bit, but then they dropped the prime rate. So the federal prime rate, to give you guys just some background here, was at 0%, zero, from here all the way to 2018 is when they started raising the federal prime rate again. Then COVID hit. They dropped it right back down to zero. And now the Fed is aggressively raising the rates because they're trying to catch inflation. Right. So, there's a lot of talk about us being in a recession or we're moving into a recession. So the Federal Reserve, what they contribute is as rates go up, slows things down, you move into a recession, right? Because people lay people off, unemployment goes up. It's just cyclical of the economy, whether it's good or bad, I don't know, but it's definitely cyclical with the economy. So my thing is, I think the Fed is going to be really aggressive to the end of the year. I think we're going to see probably high 6s on mortgage rates. and going up to probably February. And then I think we're going to start seeing reports come out that the CPI index, the consumer price index, is going to start dropping inflation. I think by the next summer, we're going to see rates drop pretty quick, because I think it's going to jam things up a little bit.
Yeah. Okay, so then can we talk? So for people that are moving, that are buying, these buyers out there that are maybe like, well, no, I don't want to buy right now when the interest rate's so high, or if it's going to keep going up, I don't want to buy it now. What would you offer just as advice, to somebody that's starting their buying process, looking into buying right now, the whole opportunity for refinancing in the future, buying now, how that works, are they going to be stuck with this interest rate and this higher payment forever? Is it temporary? What is this? What are some techniques or some positivity, I guess, maybe more so for buyers, and some strategy for them to think about if they are coming up on a move, on how to handle this whole situation with the interest rates going up, and then again, hopefully they come back down next year, or whenever we see them come back down.
Yeah, no, that's really a good point. Investors will tell you, and Warren Buffett says this. He says, when everybody's running, buy. When everybody's buying, run. And right now the markets are in a low. I want to share one other thing. I think this is good to just see. Got a few other charts here. I just want to pull up here for you guys. Right here, all-time low vacancy rates. So the millennials, again, you can't deny that there's a big generation of people. Let me see if this one, I think this one has it here. This is literally the number of households from 2007. We had 116 million households. 2021, we're at 129 million. And one thing that we don't account for during this period is builders were not building because a lot of them remembered right here.
Right.
They really started building again right here. So there's a huge demand with very little surplus. So this is what is going to continue to prop the markets up, I think, for the next at least decade. I was reading some stats the other day. They said that the United States is projected to grow another 100 million people in the next century.
Okay.
So between generationally, more people and immigration, you need more places. Right. So we didn't have that back here in 2008. So record low inventory. This is where we were in 2008. We had a 3.7 million surplus. Right now, we only have an 870 nationally. So a lot of what I've been reading, we're about a 3 million home shortage right now in the nation, 3 million. So, those are, we live in a pretty good area with a lot of demand. So I think a lot of it kind of strategizes around where you move into. Are you going to be there short-term or long-term? Questions that I ask every buyer, because then I help strategize around, well, what matters more for you, rates or fees? Right. So going back to your question, Jason, you asked about, what would I say, over the next probably year. I think the markets are probably still in a little bit of correction territory. I think we're going to see them kind of, like I said, the end of the year, we're going to kind of see it down at the bottom. 2008 was about a 38% correction nationally. I think right now we're probably around a 10 to 12. Would you agree with that, Jason?
Yeah. Okay. Yeah.
What you've been seeing. So, I think there's room for maybe for a little more as the Fed continues to raise rates. Right. It's going to slow things down, including buying homes. So people are going to drop prices, which is what appraisals are valued off of.
Yep.
So what we're going to see is the prices come down maybe a little bit more through the end of the year.
Yep.
But here's kind of the win. I think now, and I'm a testament, we're trying to buy a second home in Texas, in Dallas right now.
Yeah.
And I'm looking to pull the trigger in October, November, because I think prices they've come down significantly for a nice entry point. Yeah. So, rate doesn't matter as much to me right now, because I think by next summer, the Fed is gonna catch inflation and start dropping rates. I think we'll be back in the 4s on the government loans, low 4s by next summer.
Which would be like a VA loan.
Right. like a VA loan. So going back to this, if I buy a $400,000 loan, or if I have a payment of 400,000 plus taxes, in this market, I'd be about $2,600 a month.
Right.
So next year, if rates go down to 4.125 and I refinance during that period, my payment drops about $240. If rates go down even lower, go from 2,200, now we're talking $350 in your payment. So, keep in mind, if you're not paying closing costs in this current market,
Right.
like if you can get your closing costs covered by the seller, that's $6,000 right there.
Yep.
Um,
Yeah, with seller concessions, working with like real estate agent lender, like doing that strategy. And I think I want to highlight that of a lot of this, all this information, stuff like that, the importance of working with a lender, like yourself, working with a good real estate agent to, play with these numbers for them specifically, see like, well, yeah, you might have a higher payment and a higher interest rate right now. But, if you're getting the house price and your loan amount is going to be a little bit less because house prices are coming down, if you get a discount on the price of the house,
discount, right.
and then you also save a bunch of cash, like if you're able to do seller concessions, 5,000, 7,000, something like that, 10,000 even I've seen, to help either do some, or pay, cover the closing costs or even help buy down the rate I've seen, then, you have that $7,000 that you've saved, which would be reflected in the monthly payment. But then when you can refinance, you're dropping your payment back down, so it's not like it's going to stay forever at this, the monthly payment that you buy the house at. When can somebody refinance? So if they buy, towards the end of this year, October, November, December, and let's say rates, if they do come down a year from now, July, August, September, something like that, when can somebody refinance, and when should somebody refinance, when with rates, like how much of a rate difference should somebody refinance? And we can kind of see it can shave off, $250, $300 a month off your payment. So
yeah, I was kind of a product of what's called churning in the industry. The VA loan, the VA put some pretty stringent rules into refinancing, especially for veterans. They, 90% loan to value. If you go above that, there's a penalty that the veteran has to pay, and a lot of them like see that number and they're like, wait, I don't want to go above that number. They also said you got to at least do 0.5%. You got to do at least 0.5% in reduction. So, you can't go from a 5 to a 4.75. You have to go to at least a 4.5, right? So what ends up happening is if I think the rule of thumb is 6/8 or more. So you should go from a 5 to at least a 4.375. Or I'm sorry, 4.25, right? To get to 6/8. That to me is where it kind of starts really making sense, because on a $300,000 loan, that's about $120 a month in payment.
Okay.
What you don't want to do, because the cost of a refinance is, let's just say it's $5,000, right? So you take $5,000 and you divide that by $120 a month. It's going to take you 41 months or 3.4 years just to recapture the cost of that. So I definitely say there has to be some common sense here. And a lot of lenders, there's good and there's bad, just like every industry out there. Hopefully you're working with someone good and that really is looking out for your interest and asking you the right questions to say, hey, what's your long-term plan with the home? If it's a year, don't spend $5,000 to save 120. Doesn't make sense. So ultimately, 6/8 of a point is my general rule, but some other people, just have it in their mind that they just want to drop their payment. They don't see the expense to get there. So I think we're going to see a pretty good opportunity here in the next year and a half to go down at least 1.5 to 2%. So, and the rule is on government, 210 days is typically the rule from when you close. You have to make 6 payments. And then on conventional, same thing, like you can actually do sooner. depending on what kind of refinance you're looking to do. But again, it has to make sense. I tell folks, make sure you're getting that margin, because the money you're going to put back into your loan, and lenders will tell you, oh, there's no cost to refi.
Right.
Because it's rolled into the loan, right?
Right.
So, if you're just an uneducated buyer, and ignorant of the process, hopefully you got someone looking out for you that is not going to take advantage of you. So yeah, 210 days, 6 payments is generally the rule on the government side. Conventional can be a little sooner there.
Yeah. Okay. So just kind of recapping everything. So, what we've seen with the hike in the interest rates, and another at least 1-2 hikes in the interest rate later this year, it can still be a really good time for a buyer to buy. Things are on sale. You can still get into a house. It does affect your monthly payment, and you're going to qualify for less. But working with a good lender, working with a good agent, coming up with a strategy, figuring out what's going to work for them, with the anticipation that, well, when rates do come down, you'll be able to refinance. And, you can talk through those, how many years are you going to have the house? If you're able to cover a lot of closing costs now and get the house, at a discount, or be able to get the house less for what it's listed, plus closing costs covered, you might have a little bit of a higher payment, but, if you can refinance and take $300 off your payment, in a year from now, 18 months, something like that, then, you'll actually end up saving money in the long run. And it can still be a good time, again, where there's not as much competition. There's a lot more houses on the market, over 2,000 now versus 300. So anyway, this has been great. Super good information. A lot of information. So again, if you're watching this, find out more details. I think the biggest part of this is, connect with a good mortgage lender and a good real estate agent that know this stuff and that can talk with you through this, strategize it, look at the different prices, talk about what's your actual payment going to be in your area with taxes and insurance, because a lot of the mortgage calculators online don't, they're not configured for that, or they just show you this, and then people think, oh, well, my monthly payment's gonna be $1,852. It's like, well, no, it's gonna be about $400 higher. Like in a place like this where taxes and insurance maybe about $200 each conservatively. But anyway, we'll link you, in the description of this, so people can get in touch with you directly. People can also find Jamie Fisher on VeteranPCS.com on the Colorado page, mortgage lenders. If you have questions, obviously reach out, to you, reach out to us at VeteranPCS. It's really why this whole site was developed. There's no weird strings attached. There's no catches. It's free to use. It's free to get in contact with somebody like yourself and just have a conversation. It's military families helping military families move. And, our whole vision with this thing with VeteranPCS and what we're doing is this concept of moving with a mission, where you're doing more, through your move. You're actually able to not only get great service, yourself with a veteran military spouse, real estate agent, lender, but you're also helping to support their businesses. And then, we donate part of each one of these transactions to a military focused charity. So it's really keeping everything in the military community, where people that have been through the military, they know what a PCS move is. They're really experienced on the VA loan. We can help out our own community, our own military families with stuff like this to actually look and say, hey, maybe it doesn't make sense to buy right now. Or, if you're going to buy, here's some things to consider, and a strategy behind it, which I think is important for people. So anything else to add, Jamie?
No, I appreciate your work, man, what you're doing in the military community, because a lot of these guys, only know what they know, and they rely on us to make sure that they're taken care of. So appreciate what you're doing over there at PCS.
Yeah, hopefully, I'm sure a lot of people have, are thinking about these numbers now or have tons of questions. So again, we'll connect people with you as they reach out. And again, we'll link you in the description here so people can ask you some questions and go over some of these numbers, as this was a lot of information today, but really good information just to see kind of the aggregate and some of the trends over time. So, but anyway, we'll hang out soon. Thanks for coming on here. We'll do some more videos too, just like this, to talk through some of the specifics of like refinancing and, some of these other topics and questions that people have on VA loans.
Awesome. Thank you, Jason.
Okay. Yeah. Thanks, Jamie.
All right.